Volatility can make or break your trading account. To not get blown up, here's what you have to look out for. When you're selling options, the premium is influenced greatly by the amount of volatility in the market. When you have periods of higher volatility, you're getting paid more for taking on the risk to having to buy shares of stock. With this example for Tesla, here's what I mean. Tesla has earnings coming up in a couple of days, which means that the volatility around their area here at July 21st is going to be elevated. You can see the IV 68.6%. If I go out in time, normally IV goes up as you go out in time, but it's not going to do that for Tesla. It's actually going to go down from 68.6 down. It's going to go down to 60.5 and down again as you go further out in time. I mean, there's less volatility, so there's less premium available to you in the further out dates based on the kind of time it takes for this trade to expire. So let's say for this options trade at Tesla, you want to be making kind of an options trade and selling a put at 266 level down here on the chart. We go to 266 in our strike price here. We see that, let's call it 265. You get paid between 415 and 430 to sell that put because there's added volatility. You can get almost a 2x return on this trade in 1 week's time because of the heightened volatility around earnings. This means that when there's higher risk or potential risk in the market or unknowns, you get paid more as an option seller versus when you're going to do this when time and the volatility are low. If I was to go out a week in time here, I'd expect this kind of number to double and go up to 815, 860. Let's see if 265 does that out in 1 week more. Not quite. It doesn't quite get there. So what I'm saying is that if I go out and I do a 5-day trade or I do a 12-day trade, well, 5 days is almost half of 12. So there should be double the premium for an extra kind of week of trading, which there isn't available here. So I want to focus on the best bang for my buck. Why would I go out 2 weeks in trading time and only make 1.5 times when I can make it here at 2x in a 1 trading week going off of 5 trading days? That's how volatility helps option sellers. On the flip side, if you are buying call options, you're buying put options, what happens to you there is that it works in the opposite way. If I'm going down here and I'm looking at the 285 call, let's say I wanted to buy this call, it's going in from 985, 980 and change. When I'm doing this and I go back out, I want to maybe kind of focus on not these kind of super volatile weeks when there's earnings, when there's big kind of corporate announcements, because it costs more to do this and buy those calls. I have to pay more to actually get in my position if I think Tesla's going to pop. If I go out in time, the 285 call, again, you would expect this to double, but it's not going to. So you get a better bang for your buck going out in time. Plus you have the added chance of not having a volatility crush when you're buying these kind of long dated options that are further away from the earnings date. And again, the further you go in time, the better this trade looks in terms of how volatile it is and how much you're having to pay up. So if we extend this trade out in time and we have a 20-day trade and a 5-day trade in terms of time decay, 5 times 4 is 20. So this should be multiplied by 4 down here. If it's not, that means it's a really good trade for us as long as it's less than 4 times. If I go down to there, let's say it's 10, we're going out looking for a 40 banger right there. It's only 14 and change. So there's more value in a buying calls further out here away from these kind of periods of volatility, unless you have a really good idea that this price is going to go a certain way, because it's better if you buy these calls. If it doesn't, you're getting hammered by volatility crush around earnings dates like this or big economic events, and you're getting hammered by having to pay more upfront for the position initially. So the main thing here, no matter what stock you're going into, you want to always have an idea of when volatility is highest. I go into Meta here, the IV percentage, 54% right there, the implied volatility. If I go back to July 21st, it's 31.9. We can see there 61.5 and then 54.2, which tells you that on that week of the July 28th, it's higher than the previous week and it's higher than the week after, which means there's something happening this week where volatility is expected to be higher. There is unknown risk in the stock during this week. And in this case, it happens to be Meta's earnings call is happening this week. So if you're selling volatility, you're selling options, you can profit by having more options, more premium for you available. If you're buying, maybe you want to take this week off and not trade this week, or just go out further in time and let some of that volatility work itself out of the market. Once earnings are reported and that unknown becomes known, the stock price is impacted, but these volatility numbers also get impacted. They also turn themselves down and kind of erode over time as that risk is taken away from the market. It's like a balloon deflating. All that volatility that's baked in kind of comes shooting down. And then you have this kind of numbers kind of going back to normal as you go further out in time. The other thing to understand is that volatility is not created equal in between different companies. So understand which companies you trade and take positions on matters a lot. If I'm looking at Meta again and I go out in time, let's go out to the August 18th strike date, so 33 days away. And I'm going to look at Meta because it's at 309 or 310, let's call it, in terms of the stock price. The volatility on that day is 46.5% the IV. So let's say I'm targeting the 300 level for the strike price here with Meta. I'm going to get paid around $1,300 or 13.00, the middle between the bid asks there, to sell this put option and then go get paid to potentially have to buy shares of the stock. So again, 300 strike, $1,300 in total premium. If I do this and compare it to a different stock that's not as volatile as Meta potentially is, let's look at ACN Accenture. The stock price is 315 versus 309 for Meta. So very similar stock price. But if I go out to that same area, 300 strike, we're going out to the August 18th trading day, 300 strike. I'm nowhere near as much premium in the market right there. I was getting $1,300 for Meta. I'm getting between 210 and 235 for Accenture. Why? Because there's less IV. It's only 18.4. Now that's okay. And that's still a good trade potentially if that's what you want in your portfolio. You like Accenture, you want to trade them, and you like the technical setup. But if you want to make more bang for your buck, it's good to have a mix of volatility in your trades. Sometimes you want to trade an Accenture. Sometimes you want to trade a Meta. Sometimes you want to trade something else where it's kind of in the middle between the two of them, where the volatility is not 46, it's not 16. Maybe it's like 25-ish. That's the sweet spot for you. But understand that if you only trade low volatility, yes, you're taking on less inherent risk. But if you want to own the stock anyway, in this example, if you're selling puts, it doesn't make sense to only go low vol when you can make so much more money going high vol on companies that you believe in as well. So understand how volatility works when you're selling, understand how it works when you're buying, and understand how volatility changes from company to company in order to be a more effective trader. And if you want to take your watch list and quickly sort every single stock in your watch list in seconds and find out which ones have high volatility, which ones have low volatility, and how they compare to the historical volatility levels to quickly analyze, make sure you like this video and check this out.